GM. GM. Today's lesson, we talk about how to identify days. How to identify days where you shouldn't trade. Got a question from one of my captains, a good question. And so this will apply to day traders because the context of the question is, how do you know which days to avoid? But the principle does apply to everyone of all time frames. It's really just knowing what conditions you should trade in versus conditions you shouldn't. But it's always more clear for day traders because if you've ever day traded, as I'm sure most people have, even if you're not a day trader, I'm sure you've tried it or played around with it, what you'll see is you'll have one of those days where it just seems like nothing works. Like it feels like you're on the wrong side of the market. It feels like you don't have a good handle on it. Feels like you don't have, you're not in tune, would be the word. And a lot of that is very subjective. You're like, oh, it just doesn't feel right. I can't really get my handle on the market. I don't have confidence. My setups are not working, whatever. But to identify days that you should trade, suitable days, good days, versus days to avoid, you have to do it systematically. You can't just wake up and say, I feel good, I feel bad, I feel bullish, I feel bearish. You can't do that. So you have to set a basket of conditions, right? You have to set a list of parameters, conditions for you that equal favorable trading conditions. Now, a lot of this is going to have to come from data, right? If you've traded for 100 days, you have 100 days worth of data to go back through to find out, not from your opinion, but from your results, which days you tend to be better on. Look for any statistically significant pattern in your past history. Go back and review all your trades. You should be doing this. That's why you have that data. You might notice that you're better at certain times of day. That's usually a fatigue thing. Sometimes people are better in the morning, better in the evening, better in the afternoon, whatever. Sometimes you're better on certain days of the week. It could be early in the week, you tend to have better results. That's generally a market-based force where potentially you're a trend trader and the strongest weeks tend to trend from the start. So you might make the most of the money on Monday and Tuesday. But there could be a whole host of other factors, right? So if you have the data, review it. That's the first thing. And even if you've only traded for 30, 40 days, whatever, review that data. Go back and look. What were the winning trades? What coin were you trading? What style was it? What time frame? Which system? Why did it work? And obviously pick the outliers, right? If you've got a 50% win rate system, then, the days where half your trades win, if you take 6 trades a day and you have a 50% win rate, the days where you win 3, lose 3 are pretty much standard. The days you want to zoom in on are the days you lose 6 out of 6 or the days you win 6 out of 6. Is there something there? Is there a unique identifier that you could say, oh, turns out when this condition is present, I have better trading days? That then helps you to avoid the bad days and double down on the good days. So other conditions, right? That's from you looking at your data. If you don't have data, you can make data by reviewing your back testing. Remember, you should take every system you're taking live should have been back tested to some degree. So assuming you can back test it as much as possible. If you even want to go beyond 100, go to 200 to get even more data and then review those, right? Go back and look through the winners and the losers. What days of the week did they come on? Do they tend to be worse on a weekend? Do they tend to come on trending days? Is there some clear price action signal? Is there some technical pattern or other factor that tends to lead to more winners? Maybe you have most of the losers in a system on the weekend when it's low volatility and it's a trend system, so it needs trends and weekends don't tend to trend. Maybe it's that. Again, you can do all this and you can speed run this. You can front run it, or not front run it, you can shortcut the process. Right? When I said if you've got 100 days worth of day trading data, go and review it. You can literally go and do 100 days worth of back testing, replay trading. Just brute force it. Set up a system, go trade it for 100 days, and you can do that in one evening, right? You can go through a day on a 5-minute chart very quickly and replay trading. Boom, 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 boom. Just fly through it as if you're really trading. It'll allow you to just get a bunch of data and crunch the numbers and see where does it tend to work better or worse. So that's how you do it with your data if you have it, live data. That's how you do it with past data. And then in general, how do I avoid bad days? Well, for me, my favorable trading days almost always feature some kind of strong trend or an inefficient move. So I know that from my trading. I make the most money and have the best trades when we have trending moves. Right? That's where Bitcoin or an altcoin breaks out from a key consolidation, breaks out and moves in one direction. Whether it's up or down, it is a strong breakout and it trends, and I follow the trend until it exhausts. The other way is where we have a sharp move in one direction, and then there's not enough demand or supply to sustain that, and it reverses. Meaning, we have a sharp pump up, but it's inefficient, there's weakness, and then I trade the mean reversion, I will short it back down to where it came from. Or, we have a sharp dump, and price consolidates, and it's dumped too fast, and there's too many people short, and it's too inefficient, and it bounces back up into the gap. So those are the two main types of trading that make me the most money. So I look for days where that's happening. Now, the second part, the mean reversion, is actually easier because by definition you wait for the big move. You have to wait for a big dump or wait for a big pump. The tricky part is you have to assess whether this is a valid breakout, because usually the breakout or the breakdown is a big move. So it could be the start of a trend. But I have my identifiers for that, and I know that if it is the start of a trend, it will do certain things, and if it's not, then it's very likely to actually go all the way back. And you'll notice that those two styles I trade best are the same kind of system, because they both begin with a breakout. The difference is, one of them is a breakout that doesn't pull back, so it's a trend. The other one is a breakout that does revert all the way back, which is essentially a failed breakout. And because I know that, I try to avoid taking any other trades. Statistically, they are by far my most profitable trades. On all time frames as well. Because that actually encompasses, if you scale out to different time frames, that actually encompasses pretty much all of trading. Everything is really a trend or a mean reversion. And oftentimes both, depending on what time frame you look at it. Right? It's either trending to a new level or it's moving back to a previous level. And quite often, a 4-hour trend could actually be a mean reversion on the weekly or the daily. Anyway, that's a side point about me. So strong trends, mean reversion. Really clear price action. So this is something you'll develop again as you go along as a trader. But there is a such thing as a clear signal and a kind of bit of grey, right? The best example of this is if you've backtested a system based on BOS, break of structure, you'll know this, right? If you actually just try and trade every single BOS, so technically every single time there's a candle close above or below the previous swing high or low, you'll get hundreds of trades in a few days, right? Especially if you're on a low time frame. So obviously, just buying or selling every BOS is not the way to be profitable. You have to identify what are strong, clear price action signals. That goes back to your testing and again to your previous results. What type of BOS? So what type of breakout tends to actually hold? Because you're trying to buy the breakout for a trend. So what type of breakout tends to hold? You have to figure that out. And then look for that. That'll help you to avoid some of the false signals. Now that's how to know when to trade, really. How to know when not to trade is obviously the opposite of that. So if anything I just said is not present, you don't trade. If there's any kind of uncertainty or unexplained volatility, skip trading. This is very important. We need volatility as a trader, right? Volatility just means it moves. But it's about the degree, the magnitude. It's how much it moves, right? Every market moves all the time, but sometimes the market moves more than average, and that is the time where you can get the most gains in the shortest amount of time. If Bitcoin usually moves up and down 2% in a day, and then it moves up and down 10% the next day, that's a volatile day. That's a day where there's opportunity. But if you don't know, if you don't have some kind of idea where this volatility is coming from, what's causing it, don't trade. Because you're at an informational disadvantage. Sometimes there's volatility at random just because there has not been volatility, and it's often just to wipe out people. So this is very common. When price doesn't move, you'll see this on weekends a lot. When price doesn't move for a long time, it then all of a sudden moves really fast in both directions. That doesn't mean that there's good trading conditions. It just means as price wasn't moving, positions were building up, and then the volatility compression leads to expansion. It pushes up, takes the stops, pushes down, takes the stops, and then generally goes back to where it started. That's not really tradable. Learn to identify that, right? Trends, if they are not consistent with what you expect a trend to be, don't trade it. This is important too. When price goes up or down, if it breaks out, your desire is always to trade it as a trend. But you also have to know what a trend looks like for you. Maybe you've got your moving averages, your EMAs or your MAs. Maybe you've got your volume patterns you want to see. Maybe you've got RSI readings you want to see, whatever your system is. You do not have to trade every single trend because most trends fail, right? Every trend that fails looks like a trend at first and then it breaks down, right? False breakouts. False breakouts look like a new trend right up until the moment where they don't. So if you do, and you should try and get better at, if you do spot inconsistency with what you're used to seeing, right? A trending move that doesn't look like the trending moves you typically win on, avoid them, skip them. That can be things like the breakout, right? This is very common. The break of structure. It did actually break out. There was a BOS, but it didn't break out very far past the previous swing high. There was quite a long wick on the candle and the volume wasn't that strong. So yes, that's a breakout, but it's quite likely not going to lead to an extended move. You need to obviously make that objective. You can't just say a long wick or weak volume, put numbers on it, right? The volume was below average, below the moving average. The wick was, more than 33% of the entire candle was the wick, so more than a third. You can make this objective. Avoid forcing trades, right? So you should never, ever go in looking for a trade. Right? Don't go into a day. Just because you're a day trader doesn't mean you trade every day. By far, the biggest killer of trading accounts, and the reason why this question gets asked so much, how do I know when not to trade? By far the biggest is people force trades. They trade when they shouldn't be. This is simple. Stick to your predefined rules. Everything I said before, put it into a set of rules, write it down. If it's not met, you don't trade. Be a perfectionist. I will only act when my setup aligns perfectly with my criteria. If I have 5 things I want to see, unless all 5 are present, I will not go long or short. It has to be perfect. This is one of those times where it's really good to be a perfectionist. A lot of times, perfection kind of gets in the way of progress, but not this time. This is very good. If there's one thing you do want to procrastinate on, it's entering trades. Because most people enter too many trades too fast. And that sort of leads into overtrading, which is the other biggest killer, right? Overtrading due to impulse, emotions. Again, very simple, but most people can't do it, right? Very simple, but not easy. A disciplined plan minimizes the risk, keeps you focused on the high probability trades only, right? And it should be data driven. It should be from your back-tested results. You know this is a back-tested system that has positive expectancy, so you're going to trade it. Or hopefully, eventually, from your live trading results, you know this system works because you've used it and it's worked. And that gives you the confidence to sit patiently and wait for the trades. And that's it.